Ladies and gentlemen, welcome back to this week's edition of HECMWorld Weekly. Our first story is living proof that the CFPB, or the Consumer Financial Protection Bureau, is not dead. In fact, reports of its demise were highly exaggerated, as they say. In fact, the Bureau's enforcement actions have been strongly curtailed, but the agency recently released a proposed change to the rule or Regulation B, and that encompasses the Equal Credit Opportunity Act, and it could have an impact on HECM lending, this according to a recent story in Housing Wire's Reverse Mortgage Daily. In fact, NORMLA, or the National Reverse Mortgage Lenders Association, is urging the Bureau not to restrict age-based programs such as the Home Equity Conversion Mortgage, or HECM. Let's dive in a little deeper. NORMLA is urging the CFPB to revise their proposed changes to the federal fair lending rules, and they warn that the agency's approach could actually undermine reverse mortgage lending by restricting the permissible use of age in the credit programs. In a comment letter submitted to the Bureau on December 15th, NORMLA said the proposed amendments to Reg B would impose new evidentiary requirements on special purpose credit programs that rely on otherwise prohibited factors, including age. And the letter said, in part, "We are concerned that the proposed two-pronged evidentiary requirements, specifically requiring a lender to establish that a group with a common otherwise prohibited characteristic, in this case that would be age, would not receive credit under current lending standards, and second, that providing credit would not be accomplished through a program that does not use the prohibited basis. They say that will impose an undue burden, which will effectively eliminate the viability of age-based special programs, or SPCPs, essential for products, especially reverse mortgages." In essence, folks, the CFPB, yes, even under the Trump administration, is proposing something that would really pare down the size of the federal government's role in consumer lending. Yet, in this case, they haven't really thought about the unintended consequences because they're wanting to push hard, would be my guess. No one can know their motive, but they're getting aggressive in this cutback. But this change would really have a strongly detrimental effect on the home equity conversion mortgage. NORMLA said it would be impossible to design a reverse mortgage without considering age, since life expectancy directly impacts the loan risk and the principal limits. No alternate factor could adequately substitute for age in determining eligibility or loan terms, wrote NORMLA President Steve Irwin. NORMLA's letter requests that the CFPB clarify in their final rule that credit products that favor elderly borrowers are already permitted under existing Regulation B provisions and should not be subject to the special credit program requirements. Irwin wrote in NORMLA's letter, ECOA and Reg B already permit the favorable treatment of elderly applicants, age 62 or older, in credit scoring systems and product offerings. HECMs, which require the youngest borrower to be at least age 62 of age, fall squarely within this established principle of serving the critical market by favoring the elderly. Well, thankfully, someone was minding the store. That is the Federal Register. So a big shout out to the National Reverse Mortgage Lenders Association for catching this oversight, a major oversight, because it would have a dramatic impact, a negative impact on HECM lending. Recently here at HECMWorld, we have reported how more financial experts and planners are suggesting there is a good argument to take Social Security benefits sooner than later based on certain criteria and objectives. And now there is a very well-known financial pundit who is saying the same, albeit for different reasons. And this story comes to us from Newsbreak, saying Dave Ramsey recommends claiming Social Security at 62, which, by the way, is the youngest age. And there are benefits and downsides to this strategy. The decision when to begin taking your Social Security benefits is a pivotal one in retirement, and it can impact your cash flow for the decades to come. So that is a big crossroads. Financial guru Dave Ramsey, who often throws a curveball into conventional wisdom, is actually advocating for an early claim at 62, the earliest possible age of eligibility. Of course, you've heard it said, and perhaps it was touted as a strategy using a reverse mortgage to postpone Social Security benefits until the age of 70, which is the full retirement age when benefits are maximized. But there is an argument, in fact, for not waiting until that age, and I brought that up on an earlier episode. And one is, if you pass away before you reach the age of 70, then you have just lost and the house has just won, to use casino speak. One of Ramsey's main points is that a bird in the hand is worth two in the bush, especially when it comes to cash you can control immediately. By claiming your Social Security benefits at 62, you get the income now, which you can put to work in investments and potentially earn a greater return than delaying Social Security benefits. That, Ramsey says, allows one to take advantage of compound interest early in retirement. I think this would apply for individuals who may not be fully retired and maybe until the age of 70 or later. So if they do invest those funds wisely they're getting from Social Security, perhaps they don't need them for immediate cash flow. You can see how that would make sense. Ramsey says the math can be compelling if you have high growth investment strategy and a high risk tolerance. So we're talking about a very aggressive investment stance, which someone in their 60s should not be overly exposed to risk as they're nearing the finish line of retirement. Nevertheless, we'll continue. With the Social Security Administration guaranteeing increased benefit for waiting, a good portfolio return could actually exceed those guaranteed increases over the same time period. It's a gamble that Ramsey suggests is worth taking for those who are confident in their investing prowess. But there's another use of these Social Security funds if one were to begin claiming at age 62, and that is to begin eliminating debt to prepare for your non-working years. Claiming Social Security early provides an immediate cash infusion that can be used to pay off any remaining mortgage, car loans, or credit card balances, which would dramatically reduce one's monthly outflow and immediately reduce their financial stress. Now, there are some downsides to taking Social Security benefits at the earliest age or even before the full retirement age of 70. And one is that you have lower benefit payouts for the remainder of your lifetime in that program. Claiming at age 62 will reduce that check, and the subsequent cost of living adjustments are going to be smaller because it's based on a smaller benefit amount. While I do commend Ramsey for taking a little bit of a contrarian view of Social Security, claiming benefits, that is, I do believe that his recommendation of aggressive investments could be somewhat questionable, and will the individual actually get the returns required to offset the benefits of waiting until age 70? There was no real specific example given or a Monte Carlo simulation that I can find for that, but if anyone does know, if there's one out there, please let us know. A recent study from Mortan Asset Management is particularly insightful because it's not relying just on a survey, but it is looking at anonymized data of more than 12 million defined contribution plan participants, their spending habits and patterns from over 5 million select households. So this is quite the data sample, and it does give us some insight into debt management in retirement and how the management of debt in the years leading up to retirement can really have long-term consequences. So let's take a quick look at this latest report published by JP Morgan. It was actually dated December 16th, very recent. And the main findings that we're looking for are the management of debt and the impact on individuals. It says in part that high credit card balances are associated with lower contribution rates, that is to a retirement plan, and smaller account balances, which reduce retirement readiness by up to 40% for those participants. And some very concerning data here. Anonymized household data that Chase has shows that 48% of plan participants are carrying credit card debt, which increases their likelihood of taking a loan from their retirement plan. These high credit card balances are also associated with lower contribution rates and smaller account balances, reducing retirement readiness by up to 40% for those participants. And what about the change in spending during one's non-working years? The report shows that the average retiree's spending gradually declines by more than 30% between the ages of 60 and 85. Now, not all at once, but gradually over time. And that spending can fluctuate dramatically from year to year, with 60% of retirees experiencing annual changes of 20% or more. The study further reveals that the increasing contributions of just 1% beginning at age 25 can help fund 9 more years of Medicare-related expenses. Sharon Carson, retirement strategist at JP Morgan Asset Management, says, when it comes to retirement plans, there is no one-size-fits-all approach. Average income replacement needs can vary widely depending on pre-retirement salaries and Social Security benefits received. These findings highlight the importance of flexible, personalized retirement solutions and the challenge conventional thinking around static income replacement rates. Well, there you have it, folks. We have seen it ourselves when we find many older homeowners who have very little retirement savings, or they've just saved far less than they wanted to. And many times it's due to consumer debt, especially credit card balances that they have been carrying for many years. And so thankfully, for those that do have substantial home equity, there is perhaps a way to generate cash flow each and every month.